A lot of people love a personalized portfolio, but how do you make sure that it does not backfire? And Emerson Electric, is there good buy yet?
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Thursday, June 13th, 2024 edition. I'm Justin Klein, and I'm excited for this hour with you. As usual, answering your finance and investment questions and giving you my perspective, developed with over 20 years of investment experience. Wow, it's been that long, approaching 25 at this point. And yeah, actually, it's right on 25. I remember I first interned with my grandfather in 1999 in the heart of the dot-com bubble 1.0. I was very green, but I've come a long way since then. And my goal here is to give you all the lessons I've learned through this crazy period, as well as the many decades of studying the past, right? It's not just about your lived experience, but you can learn a lot from the things that happened in the past. There are parallels, there are differences, but there are lessons that you continually have to learn. And that's what we're here to do, is to help you learn as many lessons as possible. Hopefully the easy way, and that is to listen to experienced people like myself and others, right? I always say that I'm not the only person you should listen to. I'm not the only person's opinion that matters. I am giving you an educated opinion, but I am not 100% right. Nobody is. Even the best investors in the world are only right 55 to 60% of the time. So there's going to be things that are missed. But the goal here is to make sure your miss percentage is as low as possible and your hit percentage is as high as possible. But once again, that takes consistent work. And that's why we do the show 5 days a week, because there's new data coming in, new information, new news pieces that impact markets, economies, sectors, industries, etc. So that's what we're here to do. And we're going to run down the market performance as well as the show topics, which we have many for this hour. But as usual, we are going to tackle our first caller question now.
Hey, this is Don from Durham, North Carolina. Thanks so much for the show. I'm interested in what you think of EMR, Emerson Electric. Recently, I like the company. I'm just a little nervous about whether it's really going to keep going or you think it's going to probably pull back. So I'm looking for an entry point for EMR. Thanks a lot. Bye-bye.
All right, looking at Emerson Electric, and this is a name that we've owned for clients for some time, and they design and supply products that help with the electrical industry. Think industrial, commercial, and consumer markets. And also, on top of that, they do have a robotics division as well. And so, they're hitting on a lot of great longer-term themes. That's why earnings last year were up 21%. This year is supposed to be up 23%, and then 10% increase next year, about a 2% dividend yield. Very little debt on its balance sheet, so that's good. And, this is just from a thematic standpoint, this is a very, very solid name with good profitability. Return on equity, 43%. Return on invested capital, 31%. Okay, very high. If you watched our wealth webinar a couple days ago, those are solid numbers. Their total debt is about $12 billion on a $62 billion market cap. That's not an issue. Altman Z-score is 3.7. Once again, if you looked at our webinar on Tuesday, you'll see what that meant. Anything above 3 is pretty solid, so that's good. So a lot to like here overall. And now it has moved up since February. It was trading at about $92 per share. It hit a high recently around 116, has pulled back to about 108. But it's really been consolidating after the move that it made in February. And overall, if I zoom out to a weekly chart, that's just bullish consolidation. So to me, this is where you want to pick it up because it's in an uptrend. It's cooled off. It's slightly oversold in the near term. But all that did was work off an overbought situation that occurred starting in the month of April. And when markets get overbought, especially, or stocks get overbought on the weekly, there needs to be a period of cooling off, especially for a large name like Emerson, $62 billion market cap. So I have no problem getting into it right now as it continues to consolidate, likely for that next move higher. Now we're going into a short break, and on the other side, I will talk about today's planned topics as well as today's market activity. And please remember that you can call anytime and leave your question on the InvestTalk voice bank. If you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART. Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke. And together, we're your guides through the maze of investing. We'll bring you insights that will impact your portfolio.
Whether you're a seasoned investor or just getting started, we've got you covered with the latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and on our anytime listener line at 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So why join us? To get ahead in your investment journey with strategies, tips, and knowledge that will help unlock the full potential of your hard-earned money.
But first, hit subscribe and turn your notifications on, and let's make informed investment decisions together.
Welcome to InvestTalk. Now, we have a lot of ground to cover over the next 45 minutes, but this is what we have planned. We're going to talk about personalizing your portfolio so that your total financial picture does not backfire. So we're going to talk about total wealth approach to asset allocation. And this is something that we talk about with clients all the time, but it's always something you should think about as well. We also have voice bank questions on Iron Butterfly options, as well as a mutual fund that we're going to dig into. We also have some topics in regards to the annual reports that companies put out. What are large language models telling us about what to look out for? What are the red flags that can signal, hey, things are maybe changing within the company? In addition, this is something I've been trying to get to all week, but it's a story about how a certain city north of the border is trying to solve a glut of office buildings, and transition them into residential buildings. So we're going to look at that and how that could spread potentially to other large cities here in America. And then if we have time, how is the chip industry trying to rebuild a fragile supply chain that is threatened by geopolitical tensions? And so we're going to look at that story. Okay. We also are going to get to some questions submitted via the comment section on our YouTube channel as well. And of course, most importantly, your live calls. So if you make them, we will answer them at 888-99-CHART. Now let's take a quick look at the market today. It was a decidedly negative day overall. Large caps did eke out a small gain, but small caps were down a little less than 1% overall. You had the 10-year, 10-year yields were down. So that was interesting, is that you continue to see weakness or a down move in yields, strength in bonds. And I don't remember if we got any major economic news, if I'm remembering correctly. I don't think we did. Let me pull up the calendar real quick. I don't remember seeing one off the top of my head. Let's see if it wants to go fast enough for me. Maybe not. Oh, there we go. PPI, that's what it was. I remember that. Now I remember. Sometimes you just got to jog the memory. Yeah, producer price index, that did tick down to 2.34%. This is always a leading indicator as opposed to the CPI, which came out the other day. You had producer prices and it fall actually month over month. So the inflation picture after today certainly was better. That's why you saw rates come down a little bit. And overall, I think the market's a bit overbought at the current time, to be frank. And we'll see how we handle the rest of the week. We're still, I think, trying to digest the Fed speak from yesterday, and that usually will take a few days. So we'll get more information tomorrow. And the next week is OPEX, quarterly OPEX, and there tends to be more volatility in those weeks as well. So kind of a mixed bag in today's markets. Now, I've been telling you for a while to head over to our YouTube channel and just search InvestTalk. And we do get questions submitted via the comment section in those videos. And here's one that came in earlier. Ren says, do you like PCTY stock? And if so, where would your buy point be? PCTY. Okay, this is one that is down dramatically. It peaked back in the end of 2021. Whenever I see that, that's kind of a red flag because that's probably a growthier name. It could have been a Ponzi type stock where there's not a whole lot behind that price move. You got a lot of that in 2021. And that peaked to over $300 per share. Now this is at $138 per share and headed lower. Now, the good thing with this one, it is earning money. It's supposed to earn $6 and change this year after earning $5 and change last year. It's supposed to earn $6.76 next year. But it is a $138 stock. And that is the issue. It's just very expensive. And we said for a while that companies that trade at high multiples in a rising rate environment, they tend to not do so well. Now, what this company does is Paylocity. They provide payroll and human capital management solutions to small and mid-sized businesses. It was founded in 1997, so it has been around a while. But the relative strength is horrendous. It's down around 14, very bad. It is profitable. Return on invested capital 21, return on equity also 21. Very little debt in its balance sheet. Does not pay no debt in its balance sheet. Does not pay a dividend. Free cash flow around $300 million on a $7 billion market cap. That's about a 4% free cash flow yield. That's okay, but you're looking at a price to sales ratio still about 5.8. So, and enterprise value to EBITDA around 23. Both of those well off their highs, but is it cheap enough? And I think the simple answer is no, and the market is telling you that. And there's nothing, at least on the weekly, or let me zoom over the daily. Yeah, nothing on the daily either that's telling me this is going to turn around in the near term. So I like what you're looking at, that it's profitable, it has positive cash flow, positive earnings quality metrics like return on equity, return on invested capital. But the relative strength, which tells me this needs more correction from a valuation perspective. Okay, and until you get a reversal, this is a no touch. You don't want to touch it. And so I would keep it on my watch list and wait for a reversal, and then I might jump on. But until then, pass on it. Now let's keep things moving. Go back to the InvestTalk voice bank for a question that came in earlier.
Hi, Justin. It's Bill from San Diego. Love your show. I'm wondering about EPS. The numbers seem to be all over the place, and I was wondering if you have to look them up by industry. And if so, how would you find what the industry EPS is? Thank you. Have a nice day. Bye.
I think you're looking at earnings per share, and you're right that analysts across the street, they typically have different numbers on what they expect earnings to be for the company going forward. But there's typically an average. Now, we subscribe to FactSet. It's very expensive. Something that, on the institutional side, we have the money to do that, and that helps us with the portfolio management process. The average person, it's difficult because it's hard to get that. Market Surge, used to be called Market Smith, Investors Business Daily. You can subscribe there and get the average estimate for individual companies, but not for the industry as a whole. Like I said, we subscribe to FactSet and other data sources, and we get that. To get this stuff for free, you're probably going to need to turn to your broker. And this goes back to something I talked about on the webinar 2 days ago, which is what are the tools to utilize? And a huge factor in my mind, if you're trying to do this on your own, you need a broker that has good data that you get for free, including earnings estimates, etc. So I would turn to your broker first, and if they don't have the requisite data you want, then I would head over and maybe move your money to a broker that does. There you go. Now we're heading into a short break. I'm ready to take your calls at 888-99-CHART. Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Did you enjoy our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts and get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join the community of informed investors.
Now today we're going to touch on ways you should personalize your investment approach beyond just standard index funds. Now some brokers call this direct indexing. You can simply just call it a more personalized approach to asset allocation. And now on the direct indexing side, a lot of providers, direct index providers, they can segment up a portfolio or create a portfolio based on certain sector exclusions or inclusions based on the environment, social, governance considerations, etc. But, and I've seen this with, I think it might be Schwab or Fidelity, where you can pick that, right? You can make your own, they use some tool, AI, to create some portfolio that says, hey, I want to invest in AI, or I want to invest in industrials, or whatever, right? Some thematic way to build a portfolio. And while that's interesting, and that's sexy, and that might be fun, the real answer you should look for is, does it work? Right? Just because it has an interesting, cool name, does that really mean that the overall allocation, A, is going to work for the market that you're working in, as well as does it work for you and your total wealth picture, including your non-investable assets, right? Non-traded assets like real estates, pensions, Social Security, etc. And for a lot of people, especially those that are working at big corporations, publicly traded corporations, a lot of them get RSUs, stock grants. They have stock buy programs or purchase programs. We had one yesterday that they work for a utility company, right? Not the sexiest company in the world, but the utility company gave them, I think it was for every $9 he puts in, they put in $1 worth of shares. So a lot of people have these options, and that becomes a pretty big part of their overall portfolio. Not to mention, maybe you invest in a lot of real estate. You have a lot of rental real estate. Well, that's kind of like a bond in a way, right? Or like a high yield bond, maybe a riskier bond than treasuries, but still bond-like. So how to think about, your overall equity allocation should take into account all of your other capital, your other assets. Most importantly, your human capital. Right? What is your likely earnings trajectory over the next 10, 15, 20, 30 years? And usually that human capital is what creates, once again, that stock-based compensation. And share-based compensation is on the rise. It's quadrupled from 2007 to 2021. Went up to 4.4% of total revenue that companies produce. And so this makes it even more important nowadays to diversify this specific risk in an investor's portfolio. And every few years, there are reminders why you should not tie up too much money in your company plan company stock, along with your income, right? Your income is reliant on that company, as well as a significant chunk of your retirement portfolio. Now, I always use the example of Enron, but just look recently. Think of Silicon Valley Bank. That was just a little over a year ago, about 15 months ago. They collapsed along with a few other regional banks. And the Wall Street Journal reported that SVB stock made up nearly 20% of the company's retirement plan assets. And that company stock went to zero. So those employees lost their jobs, as well as a significant portion of their net worth. 20% was the average. Some probably less, but many others, maybe a lot more. So they were overly exposed to firm-specific risks. And you can go back to COVID, right? Think of the type of companies that plummeted when the lockdowns happened. From casino stocks to cruise ship stocks, etc. Anything that was in travel and leisure took it on the chin. Think of Boeing, right? Boeing's been struggling for many years, and obviously the COVID crisis made it worse. But when you tie yourself to a company, you never know when things are going to go bad. Maybe that's internally created due to bad management, i.e. Boeing. And maybe it's just something that happens in the broader economy that you can't control. You just never know. And so what you want to do is not only limit your risk in that one name, but what about your investment strategy? How much overlap is there when you are, say, indexing? Right? Apple, after its recent surge, is back as the largest company. If you work for Apple, you might own Apple stock, and there's nothing wrong with that. But if you're also indexing, you're exposed there as well. So having a total wealth approach to your allocation is vital, and it reduces the drawdowns in portfolios and ultimately gives you much better risk-adjusted return in most instances. So I wanted to highlight that because it's important, and we do this with our clients when it comes to planning. We figure out what to do with those RSUs, how to plan for them properly, and to diversify the portfolios as much as we possibly can, and you should do the same. Now we're heading into a break. I'm ready to take your calls live at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
On the next Invest Talk, we will look into this story. Humans have memories, but stock markets don't. Stock market is an immensely complex ecosystem driven by a multitude of factors, including economic indicators, company performance, political events, and investor psychology. So we'll dig into that story tomorrow, but let's play another voice bank question from 888-99-CHART.
Hey, this is James from Georgia. I have a fund that I had from a 401k, which it was a Roth IRA or whatever, but I had with a company that I worked for years ago. It was with Principal, and I rolled that over into a traditional IRA account on my TD Ameritrade platform. The fund is SAGPX. I don't know anything about this. I'm curious, would you recommend me selling this fund, maybe reinvesting this in some other ETFs or equities that would perform well? Because I know the environment has totally changed. Seeking your advice. Love the show.
All right, looking at SAGPX, this is Principal SAM. SAM stands for something, I'm not sure what it is. Conservative Growth A shares. Now, first this is a lesson not for the caller because he already bought the shares. He might have been able to get this waived because it was within a 401k. That happens a lot with A shares. The load is waived, but it is a 5.5% load. And so you definitely don't want to be paying that. You already might have paid it, but that's irrelevant. That's a sunk cost, whether you paid it or not. but just kind of a lesson there for everybody else. Now, ongoing cost, though, that's something you do pay, which right now is 1.15%, which is very high for any mutual fund, almost any mutual fund, especially for something like this. So that, number one, that's high. Now, you're also paying a 12B1 fee of 25 basis points. So if you were to own this particular fund, you don't want to own this share class, first off. So you definitely want to sell this at a bare minimum, buy the other share class that doesn't have the 12B1 fee. Now, for everyone out there, if you have any mutual funds, you should be looking, does it have a 12B1 fee? You should be able to find this on Morningstar.com and elsewhere. You should never pay a 12B1 fee. This is basically just a kickback to somebody who sold this fund to you every single year, and you're only paying it because you're owning this particular share class. Now, this was a common practice, but because of regulation and just making it clear that these people that sell these loaded funds and at 12B1 fees, they're not acting in the best interest of their clients. They are a broker, and this is how they're making money. They don't care whether this fund is good or bad or average. They just care that they're getting their load and they're getting their 12B1 fee. Okay, so that's a huge red flag right there that you don't want to own this. Now, the fund itself overall, Morningstar gives it 3 stars out of 5, so it's average, and it is frankly a fund of funds. It owns a bunch of different principal ETFs, mutual funds within it. Its top holding is Principal US Mega Cap ETF, and then a Principal Capital Appreciation. So it's just spread out all over the place. It has about 78% equities, 15% fixed income. It's an average fund with high fees. So I think you can certainly do much better. I would sell it, move on, and find something that maybe complements the rest of the portfolio. And if you want to do a portfolio review, I encourage you to reach out to myself. Just head over to investtalk.com, click on the portfolio review button, and schedule a time with me. Okay. Thanks for the call. Now let's talk a little bit about annual reports, earnings reports, and there's some interesting new data from a couple of reports, a couple of places. Number one is Morgan Stanley, their quantitative research team, has looked at US 10Ks and 10Qs. So 10Ks are annual filings, 10Qs are quarterly, and they ran it through natural language processing. And this is something we have with FactSet and we utilize as well. But what it basically, the data is saying is that when a company changes the way that they are talking about the business, that is a red flag. It's a sign that probably something is going wrong. When everything's going fine, there's no reason to change the way you're speaking about the business. It's just kind of business as usual. But when a company rewrites how it describes itself and the current status of the business, it's a significant signal that most investors probably miss. But the numbers say more than 4 times out of 5, it's followed by weaker share price going forward. So what Morgan Stanley says is that companies exhibiting significant alterations in the language and structure of their financial disclosures relative to their prior year reports generally underperform compared to those that demonstrate narrative consistency. And the big reason for this is because in the US, the C-suite has a duty, fiduciary duty, to warn shareholders if things change. So there's a significant risk factor if they do not change their language when their business changes. They risk a class action lawsuit. So this really mainly applies to U.S. companies. So that's one factor to consider because of that litigation risk that hangs over the company, the C-suite's head. Now, there is a bit of a caveat, though. Around a crisis, it doesn't work as well. The signal gets a bit noisy. But in a general, low unemployment market or economy, in an economy that is generally growing, it does have significant predictive power. So, as with anything, you can't just have a blanket statement that every company that changed their language, things are going to hell in a handbasket. But it is a significant red flag that you must pay attention to. And you need to have the tools, either through systems like what we have, or the tool, the time, and the expertise to go through these and find the differences. To how they're speaking about their company, the economy, etc. So you can weed out the problem stocks. And when you can do that, you can leave a portfolio that may be dull. It may, not a lot's changing, but that's a good thing. When not a lot's changing, that is a good thing, not a bad thing. Now here's another question from our YouTube channel. Jim says, PAYC, Paycom, is at a 52-week low. Do you think it's a buy here? Well, this is very similar to the previous question. It's in a long downtrend. Paycom peaked in, let's see, when was that? Late 2021, very similar to that previous question, around $560 per share. Now it's at 141. 141. So the previous one was Paylocity. This is Paycom. Now, a little bit different company. Paycom. Actually, no, it's the same type of company, right? It's a payroll and human capital management software company. It's funny. And this is also, there's a lot of hype around, digital platforms to handle HR, payroll, et cetera, et cetera. And this is another company that has good profitability. Return equity is 33%, so even better than Paylocity. No debt as well. That's good. They pay a little bit of a dividend. That's positive. Their shares outstanding, those have been pretty steady, so that's good. I like that they're not issuing a bunch of shares. Their free cash flow, $283 million on a still an $8 billion market cap. Still around that 4% free cash flow yield. Not amazing. And earnings next quarter are supposed to be down 2% year over year. Earnings just continues to, that was Paylocity. Let me pull up Paycom. There we go. So earnings are slowing here. That also is down. It's expected to be down 1% next quarter, year over year. Revenue is only supposed to be up 9%, whereas a year ago it was up 30% of revenue. So this is a perfect example. Both of these companies are perfect examples of what happens when growth slows and multiples come down significantly. And Paycom's free cash flow peaked in the third quarter of last year at about $300 million. Now it's down a little bit, $283 million. So you're not getting cash flow growth here. It's still trading at a price to sales ratio around 4.6. That's pretty high. Both are getting there. Let's just say that. But I would need to see a reversal. And neither are showing any signs of reversal in the near term. And especially if you are going into maybe a weakening jobs market, companies like this are going to be in less demand. So I would pass on both of these for now, but interesting names to keep on a watch list. Thanks for the call. Now, I hope you tell your friends about InvestTalk, and they can call in as well, live from 4 to 5 Pacific time. But for now, let's grab another caller question from the InvestTalk voice bank at 888-99-CHART.
Hey guys, my name is Kevin White from San Francisco. I wanted to know about iron butterfly options. I'm pretty experienced in options, but I've never really touched this one. And I was wondering, would it be considered, I guess I would call it a passive aggressive investment, to hunt for flat stocks that are profitable companies and then use iron butterflies to make income over 6 to 9 month periods? Or if that just simply wouldn't work? I'd love your feedback on that. Thank you.
Well, it would work if you're picking the right names. And in the option market, there's something called implied volatility. Implied volatility. And iron butterflies work when you sell implied volatility on these options at levels that are lower than realized volatility. Right? Because the option market is pricing in a certain, it's kind of like a spread on a sports game, right? In most iron butterflies, you're probably going to make money. But your return's not very high when you do. Okay. So for everyone else out there, what they're doing is selling near the money options and buying further out of the money options. So you're getting a net premium because the near-term options are worth more than, the near the strike price options are worth more than the farther out. You buy the farther out to hedge yourself with major market moves. But ideally, you want the market or that stock to kind of go nowhere. And those options to all expire worthless, and you keep the net premium. That's basically what an iron butterfly is. You do it on both calls, on each side, both upside and downside. Now, that option market is going to price in some sort of implied volatility. Say it's 30%. And if the realized volatility is less than that, you're generally going to make money. But if it's more than that, you're going to lose money. It's like betting on the favorite in a sporting event. You know, I'm big into basketball. If you go watch an NBA game and it's one of the better teams in the league versus one of the worst teams in the league, the spread's going to be somewhere in the teens, right? 13, 18, 20 points. And you can bet on the favorite and you're probably going to make money. Because they're probably going to win. Now, are they going to beat the spread? That's another question. That's more complex. So it's all about what that spread is, what the implied volatility is. So it's not straightforward. If you know a lot of options, you should know options are not straightforward. There's a lot of variables to consider when you're thinking about options overall. So make sure you have a very strong grasp on what the risks and rewards are for iron butterflies if you're going to execute on them. And you can't just blanket make a statement that they're all good or they're all bad, or it's a good strategy or a bad strategy. It's really about how you execute it. Now let's talk a little bit, and I'll probably finish this after the break, but let's talk about office buildings. And there is a city north of the border, Calgary, Alberta, Canada. And it actually has one of the most aggressive programs in North America to help developers convert office buildings into residences. And many American officials are actually heading up there to figure out how they're doing it. Now, Calgary, if you don't know, it's in the heart of Canada's oil industry. And in 2021, they had some of the highest number of office buildings or office square feet per capita. And they've developed incentives to convert a lot of these buildings. In April, a 10-floor building with 112 rental apartments, known as Cornerstone, was the first former office to open as an apartment building, and another 11 conversions projects are underway. And so delegates from New York, San Francisco, Chicago, Washington, and other large cities are starting to study how are they incentivizing companies or developers to make this happen. So after the break, I want to get to a little more details here because I think it's going to be vital, and it's going to be a long-term project probably, to change the way our downtown cities look in this country. Now, this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday, and this will help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART. We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Thanks for watching, and don't forget to like and subscribe and turn your notifications on because you don't want to miss a single episode of the InvestTalk podcast.
Now, before the break, I was touching on Calgary, Alberta, Canada, and the fact that they are they have a bunch of projects in order to transition these offices, these empty offices, into residential rental units. And this all was sparked by the drop in oil prices. As I said, their economy is really driven by oil prices. And during the pandemic, obviously, oil prices went negative. And so at a certain point in 2021, office vacancies in the city rose above 30%. And what did that do? That dropped tax collections dramatically and forced the city to make up the loss by collecting more from existing commercial building owners. And nobody liked that. And so there was a struggle to find a way forward. And many North Americans or many U.S. cities are starting to come into the same issue. The U.S. vacancy rate for offices hit a record 13.8 in the second quarter and is expected to continue to rise. Now, obviously, that's nationwide, but there are certain cities that are well over 20%, like Boston and New York. Now, many of these cities have started to institute tax breaks, zoning changes, but a lot of the incentives so far require low-income housing to be built, etc. But frankly, the biggest roadblock here is actually the cost of labor, the cost to actually do these renovations, because they're in such high demand. That the workers are in such high demand, and the material is expensive, etc. And so it's a big risk for these developers, but it's pretty clear that the actual price that these projects need to change hands at to make the conversions worthwhile at this point are actually equal to the land value. So the building itself doesn't really have much value anymore, which is pretty interesting. So I don't think this is going to be solved anytime soon. But over time, cities like Calgary are going to test different incentive programs. They already are. Most of them aren't working yet. But there's a point, everything has its price, right? From help from the city and state and local governments, what kind of subsidies, tax breaks, et cetera, are they going to require? What type of low-income housing requirements are they going to have? In Canada, they don't have that, mainly because there's not as much of an issue, I think, there as other cities. But also, over time, the costs to renovate these places should go down. New design improvements, etc. But this is the path forward for office buildings in downtown areas. And the banks, they see this and they are continue to kick the can down the road, and that will happen consistently going forward. So that's where we're at. And let's see if we can squeeze one more caller question in before we close today.
I was just wondering if my strategy through my 403B and the teacher's retirement fund is valid if I do like 30% each in 3 Vanguard index funds and just keep pumping into those over the years. Is this a good long-term strategy? Thank you for your advice. I appreciate it. Bye-bye.
Oh, you're not giving much information there. I don't know your age. I don't know your overall risk tolerance level. I don't know what index funds you're talking about. I don't know. I need you to give me more details. So I think you need to give me a call or head over to investtalk.com and click on the portfolio review button and give me more details. Schedule a call with me and we can go over this and figure out whether those index funds make sense for you or not. That question is far too simple for me to give you a detailed answer. Thanks for the call. Well, that about does it for this episode of InvestTalk. I'm Justin Klein, and I remind you that to head over to iTunes, Google Play, or Spotify, and be sure to rate and review on iTunes as well. And I hope you've heard that the InvestTalk podcast is also available in video form over on our YouTube channel, so head over there and search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.